Welcome to Money Matters with Southern Michigan Bank and Trust, where we talk to the experts in our team to answer your financial questions.
We're sitting down with Shaun, Vice President, Wealth Management Officer, to talk about investment planning.
Well, my name is Shaun Fetter. I'm a Vice President and a member of the Wealth Management team. My official title is Wealth Management Officer. And what we do in wealth management really is to provide holistic financial services to individuals, families, non-for-profits, and government agencies, and sort of make sure that we can identify goals and help them reach them.
So, Shaun, everyone's investment strategies are different depending upon their needs. How does the investment philosophy change from client to client?
Yeah, it's important to lay this out and get a good understanding of what the client's needs are before we dive in, because what we find is no two clients are going to have the same needs, and that's going to drive the way that we put together their solution. So the philosophy is always going to be geared towards a long-term strategy. We want to be very tax efficient in the way that we put together portfolios. And so what we'll do is identify goals, build investment solutions that will meet those goals, and then do so on a risk-adjusted, tax-forward basis, and try to mitigate taxes throughout the process, but really have a goal begin with the end in mind and build the investment solution around that.
This relates back to investment goals. How can an SMBT Wealth Management Officer help clients set curated goals?
One of the first things that we try to do when we sit down with a prospective client is get an understanding of what they want to do with their wealth. And everyone is different, and a lot of times people don't know. It could be something as simple as, I don't want to outlive my assets. And if that's the primary goal, that's fine. But when you start to build in family relationships and potentially leaving legacies, that changes the dynamic of what we want to think about as it relates to goals. So we may have a family that wants to leave a small business to their children. Well, that's going to drastically change the way that we put together a financial plan, because we want to be very tax efficient with the transfer of a business. You could have someone who wants to make sure that their grandchildren don't have to worry about educational costs, which are always rising. And in that case, we can talk about setting a goal of using things like 529 plans and front-loading 5 years of annual exemptions. And this can get technical, but there are strategies that we can do to make sure that their goals can be identified and planned for, because they all are very, very different.
And Shaun, a financial plan can be built specifically for a client's needs. Can you tell us more about the benefits of this aspect?
What's great about a financial plan is it's really a living thing. So when we sit down with a client, we can pull up our financial planning software and we can have discussions on the fly about expenses now, expenses in the future, installing a travel budget or a gifting strategy, and we can actually make those changes in the room, and we can see how outflows can impact net worth and a probability of attaining those goals. So it's never something that we set and forget. Every time we meet, we're going to confirm if the risk tolerance is still appropriate. We're going to see if there's any changes in income or expenses. We're going to talk about estate planning, and that's a continuous change. If you have a birth in the family, a death in the family, a new job, this is all going to trigger ways that the financial plan is going to change, and the investments change along with that. Typically speaking, as someone gets a little bit older, they're going to want to take a little bit of less risk in their investment because they're going to need this money to live off of. So we're going to change the aggressiveness of a portfolio as someone progresses through stages of their life. As someone who may have just started working and has a 30, 40-year time horizon, we can stand to be a lot more aggressive in our investments. But as they get nearer to retirement, we may want to pull back and introduce some less risky investment strategies. So it's constantly evolving.
And how do you track a client's investment performance?
Yeah, the tracking is pretty straightforward. We'll take a specific period. And let's just say it's a quarter. So the first quarter, 2023, what the market value of those assets were at the beginning of the quarter and what they were at the end of the quarter. And that kind of tells you your performance on a percentage basis, and we'll pull the fees out to give them a net performance for that period. And then we can break that down further by asset class. So we can take a look at large cap equities, small cap, mid cap, international. We can look at fixed income, real estate, other alternative investments, and we can see how each sector is doing. And then what we really want to do is we want to peg those against what we call a benchmark. Some very common benchmarks are the S&P 500, the Ag Bond benchmark, and we can give an apples to apples comparison if we weight those holdings so that we can really see how we did against a stated benchmark, or a blended benchmark is really what we want to do to make sure it's as apples to apples as possible.
What is a blended benchmark?
Blended benchmark is essentially incorporating several different benchmarks that match the way that a portfolio is invested. So to make this very, very simple, if you just had a portfolio that had half of your investments in large cap stocks and half in investment grade bonds, so 50-50. Instead of just using the S&P 500 or just using the ag, we would use a blend of those, and it would be 50-50 to make sure that our allocations matched the way we were invested. It's much more complex than that when we build out a portfolio, and we'll have 38% weighting to large cap, and that's what we'll use as a 38% portion in the benchmark to the S&P 500 because those are like investments.
Shaun, what tips would you give someone who is just starting out in investing?
Well, I'd say start early, but I would also say adopt healthy financial habits. There's good debt and there's certainly bad debt. And when we're younger, we tend to accumulate debt just because we might not have as much liquid investments to be able to have to put to the side. So being very mindful on not carrying toxic debt like credit card debt is very important. But as it relates to investing, take a look at a budget and identify what you'll need to survive. And whatever you have extra, begin putting that into an investment that won't keep you up at night. So if you're younger and you've got some tolerance for risk, then yeah, you're going to want to be aggressive and put that in the stock market. But the earlier you can start, the better. And the second thing I would note about that is as it relates to when we think about savings and investing and getting started, there's two main avenues for that. One is through your employer, and we think of things like 401ks, and you really want to make sure that you're contributing at least enough if your employer is going to offer a match that you can maximize that match. That is absolutely free money, but a good target is 10%. So 10% of your base salary, you'd really like to save that, and if your employer is going to match up to 3%, if you do 5, try to do 7% because the 7 and the 3 will get you to the 10. And anything on top of that is also very wise. So through your employer is one way, and then outside in a taxable portfolio, you want to save there as well, but you want to be mindful that you're not saving money that you're going to need for your living expenses.
Let's talk about hot stocks. Many people can get hung up on making quick money off certain stocks. What advice would you give to them?
When you sit at a poker table, they often say, if you don't know who the sucker is, it might be you. And we see that sometimes with the quote-unquote hot stocks. Fortunately, there's been some really good study in behavioral finance that points to us that following the hot stock isn't always the right move. The way that a study that I once read broke it down was if you're going to buy a nice suit and it's $1,000, and you go into the store and you say, you know what, tomorrow I'm going to buy that suit. You go back tomorrow and it's $1,100. Well, you're going to be a little upset, and it may even deter you from making the purchase because you thought you could have it at 1,000. Adversely, if you went into that suit store and it was 900, you'd feel very fortunate, and you'd say, "I'm going to certainly buy that right now." That mentality doesn't ring true when we talk about investing. If there's a stock that you're tracking and it's a hot stock and everyone's talking about it and it's $1,000 a share, and you say, "You know what, I'm going to buy that tomorrow," and it goes up to $1,100, you're just going to fall in line and say, "You know what, everyone's right, this stock's incredible, I'm buying this right now." And if it dropped to 900, you might really start to think that this is a toxic stock and you don't want to touch it. Well, that's the exact opposite of the way that we think about purchasing. We've got a flawed mentality when it comes to investing our own money. If you liked something at 1,000, you should love it at 900, but we don't tend to think that way. So what I would say is, if something is in the news and the price is going way up, you've likely missed a good time to get in. You might be getting in late. And so we advocate a real disciplined investment strategy, saying, ignore a lot of the white noise, stick to the plan that we'll put in place. It's a long-term investment strategy. There's going to be volatility, but historically we know if you have a nice buy and hold strategy, and try not to do what they call market timing, which is very difficult because not only do you have to be right once, you have to be right twice. Which is near impossible in investing. So rather than following sort of the hot stock topics that you hear on the news or at the water cooler, really having a dedicated, disciplined investment strategy tends to be a lot wiser.
Shaun, how can you wrap your head around the benefits of investing?
There's a way to have money work for you. So you go to work and you work, and that creates income for you and for your family to live off of. But there's also a way to have your money work for you. And the earlier you can start doing that, there's a very proven thing called compounding interest, which is where not only does your money make interest, but the interest that you earned makes interest, and it just snowballs and can really turn into quite a windfall. So aligning yourself with a good financial advisor, if you don't have a great grasp on it, is a very wise move, because you really don't want to be fearful of investing, because there's going to come a time where you may just be a little bit too disinterested in work, or you may not have the ability to work, and in those instances you're going to have your money working for you. So the earlier you can start it, the more comfortable you'll be in retirement.
What advice would you give to someone who is searching for a financial advisor?
Yeah, there's a word that floats out there called a fiduciary, and it's gotten a lot of traction lately. And what a fiduciary means at its core is that you have not only a legal but an ethical and moral obligation to put your client's interests before yours. And you'll go to any financial advisor and they're going to say that. And for the most part, they absolutely do. But one way that it can be tested is compensation. And when I say compensation, I mean the advisor's compensation. So we look at broker-dealers. These are places like Edward Jones, Ameriprise, UBS, Morgan Stanley. And their brokers are compensated based on the solutions that they purchase for their clients. And we think of that as a commission. And more often than not, they will get put into investments, the clients will be put into investments that have a high fee, and the broker collects a commission on that. And I'm not saying that that's not the right solution for the client, but it does it tells a story if they've got two investments options, similar risk. One just might carry a higher expense ratio, or is a multi-manager fund, and if they opt to put their client in that, you do have to wonder whose interest was really at heart. I look at the same way with annuities. Annuities fit for the right client, but they're not for everyone. And broker-dealers do tend to stand to get a nice commission when they implement those strategies for their clients. On the flip side, a fiduciary, like Southern Michigan Bank and Trust, we do have an obligation, we are a fiduciary, to act in the best interest of our clients. Our fees are not structured in a way that the bank makes any more or less money based on the investments that are put in place, but rather on the performance themselves. We're an asset-based manager, and so our success is really tied to our clients' success. As their portfolios increase in value, our fee would proportionally increase as well. And the adverse is true. If our clients' portfolio loses value in down markets, then our fee would be less as well. So I would really give an urging to people to make sure they align themselves with somebody who has that fiduciary tag associated with them.
Lastly, Shaun, what would you say about the wealth management officers at SMBT? What makes this team stick out?
Well, I would just say that I joined the bank in January of 2023, but have been in this industry about 20 years. And what I really find special about this wealth management team is not only the services that we can provide, but the team mentality of which we do it. So while we do have the ability to do investment management for our clients, of course, we also have the capabilities to do comprehensive financial planning for anyone just starting out or anyone who might be entering or into retirement already. And one thing that really, I would say, separates us from a lot of our competitors, those that might be registered investment advisors or broker-dealers, is we have the ability to serve as a successor trustee and an executor or personal representative for a client. And that is important. I think it oftentimes gets overlooked. I like to tell the story of myself. I'm the youngest of 5 children, and I'm in this industry. And my father asked if I would, if he could name me in his will as executor, and it took me all of 3 seconds to say absolutely not. Number one, I'd be, really biased. I have 4 older siblings, and I don't want to be the one to tell my sister she's not going to get the grandfather clock. And also, it's not really fair for a child to be put in that situation, to have to deal with the settlement of an estate right after they lose a parent. And so I do encourage a lot of people to think about a corporate fiduciary to help settle their estate, and also as successor trustee of their revocable trust. We can have a seamless administration in the sense of a death or an incapacitation, and the bank can step in and really help a family with the payment of expenses and payment of bills and the ongoing administration of the trust. And this is something that the team here at Southern Michigan Bank and Trust has a ton of experience doing. So I tend to lead with estate planning a lot because it's a very familiar spot for me, but it's something that can oftentimes get overlooked when we focus just on investment management. Investment management, as a lot of advisors do, but I'd like to say that we're much more well-rounded in the fact that we can work with our lenders and our retail bankers to really provide a holistic solution from our clients, all the way from just starting out with the purchase of a new home, starting a new business, doing investment management, doing comprehensive financial planning, and really getting all the way into estate planning. It runs the full gamut here.
Thank you all for listening. Watch out for another session of Money Matters with Southern Michigan Bank and Trust soon.